What's the deal with Carnival Cruise Line? Is it a carnival or is it a cruise line? If I could do a Seinfeld voice, I would do it. A lot of talk going on in the YouTube space regarding Carnival Corporation, ticker symbol CCL. Jeremy from Financial Education has weighed in. He's in the process of constructing a $100,000 position in the stock. Ally from Ally's World of Stocks is building a position as well. PPC Ian effectively says the stock is a watch. Nick from Positive Investing is a little more skeptical, which I feel compelled to stand in solidarity with his strategy. Me being another Nick and all, though I'm not sure that's the best way to determine sound investing advice. At the same time, I haven't found any evidence to the contrary. Okay, so what does Lemonade Stand think about all this? Inquiring minds everywhere want to know. I could be overestimating that detail. Well, let's look at the chart. Okay, so it's not the prettiest, admittedly, but we can work with this. Here you see earnings have been growing nicely since 2013. Annual earnings growth of 14% for this period, which is impressive, while earnings before this period were negative, actually. The same case can be made for RCL as well. 21% earnings growth annually since 2013, and prior to that, less than 1%. Norwegian, ticker symbol NCLH, doesn't have data prior to 2013, but the story is the same afterwards, with 22% earnings growth. No dividend with this stock, so factor that detail in. Without digging too deep into this 2013 inflection point, the industry has benefited greatly from consolidation in this space. Oligopolies and high barriers of entry are good for business. Demographics and the shift to an experienced economy have certainly helped as well. Okay, back to CCL. With the price on the graph, you can see that this has been a pretty bad investment, basically doing worse than inflation during this entire period. I mentioned in another video the importance of time in the market rather than timing the market, but clearly time has not done much for you here. Throwing the normal PE line on the chart, you can see that buying at better multiples was important. Chopping time off the graph, we have what looks like a much better company during this period, and the stock certainly looks cheap relative to itself. I like to talk about wedge deals when I'm doing YouTube stock analysis, and I will continue to do so until Meet Kevin acknowledges my existence. Here we have stock price depreciation by 38%, while earnings have continued to go up, and expectations are for the earnings to continue, but at a slower pace. This implies a potential 80% upside to capital appreciation. The wedge is strong with this one, relative to its buddies anyways. But here is what I think many investors in the YouTube space are looking at. The dividend is 4.5%, over that now really, and the payout ratio is under 50%. With the earnings seemingly being safe, this seems like a good spot to enter this stock. Or is it? Who knows? I don't know. Let's look at the analyst scorecard. They have been pretty off the mark, but save for the last 4 years where they've actually been pretty accurate. Looking at forecasts, assuming analysts are correct and the PE remains low, it's actually reasonable to expect double-digit returns. If the stock returns to a more historically normal PE, profound returns are possible. The market just doesn't hand us these opportunities. There is risk associated with these potential rewards. The bet here is that the 38% clearance on the stock price has all the headwinds baked in. Headwinds like the trade war, the Cuba ban, a couple very bad hurricane seasons, fuel costs, Middle East turmoil, malaise in the European economy, coronavirus, and recessionary fears as well. CCL is highly sensitive to the macroeconomy. Investors, especially dividend investors, are scared of this. You can see here, represented by the white line, that the dividend going into the Great Recession tripled with apparent room to run. But then this happened, and it took almost a decade for the dividend to recover. At some level, investors are baking this into the stock price, and that's why we're getting an impressive yield. I would argue that CCL is more equipped now to weather an economic storm, if it were to happen again, that is. And by the way, while we're talking about this, it having been 10 years since the Great Recession doesn't mean anything. The time, that is. Bull runs don't die of old age. I think the CEO has it correct here when he says Carnival has value relative to land-based destinations. and that should be recession protective, that along with the excellent balance sheets. But how does any of this fare compared with their competitors? I'm really glad you asked. Here is a total return comparison beginning from 2013. CCL is the laggard, but past performance isn't necessarily indicative of future returns. RCL certainly has more earnings growth, though you are paying more for it. The PE is north of 12 versus PE south of 10 for CCL. Forecasts look good, maybe better. It's important to consider that analysts have been more accurate at predicting earnings for this company. Dividend yield is lower, but the compounding annual growth rate for the dividend is much better, and the payout ratio is better too. CCL does have better balance sheets, and the EV to EBITDA is much better. For an explainer on what that metric means, check out my last video which covered whether or not Amazon is cheap at a share price of $2,000. Want even more growth? Check out Norwegian. NCLH has the best earnings growth, accurate analysts. Forecasts are good, but maybe not as favorable. The EV to EBITDA puts the stock in between RCL and CCL, but with the best growth. Remember again, no dividend here, but in a way that's a competitive edge. Management, hopefully, should continue superior earnings growth relative to its peers. Which is better? CCL, NCLH, RCL? Who knows? Seriously, I have no idea. Does anyone know? Interestingly, I think the attention CCL is getting in the community is a good thing. I gravitate more to stocks like RCL. I think all of these are actually good investments overall, each with similar macro risk. People should have some exposure to this space. I think there is value here at the moment. Let's actually have a sidebar. Give me a second here. The headwinds I mentioned earlier, all of those things are reasons not to buy the stock. But if you wait for the headwinds to subside, like good news comes out, trade war's over, Cuba ban gets reversed, etc., then the market's going to reflect that new information in the stock price. And this goes for any individual stock. So if you're going to go the route of investing in individual stocks, get used to good opportunities being clouded with potential risk, and maybe a lot of it, because it's the risk that's actually providing you that discount in many cases. To wrap up, the wedge is strongest with CCL. Balance sheets look best, but analysts have a better track record with RCL and NCLH, and they have more meaningful earnings growth. If you're not a dividend investor, simple, go for NCLH. Want dividends? Divide your position between CCL and RCL. Both might be great investments, but I can't discern which might be best. Make sure you diversify with companies that are less sensitive to macroeconomic factors. Well, that's my 2 cents, guys. What do you guys think? Are you interested in any of these names? Any plans to buy in the future? What do you think of Jeremy building a $100,000 position in CCL? Let me know in the comments. Remember, none of this is investment advice. I'm just an idiot on the internet with a lemonade stand. See you guys on the next one.